Hello and welcome. I'm Kelly O'Byrne and it's time to take a look ahead at what could drive the markets this week. It's a light week on the economic data front, allowing traders to digest recent releases such as the Fed minutes, UK inflation and wages data, and the European growth figures. Positions can be readjusted before the activity returns to the normal pace in September. The Jackson Hole meeting will be in focus next week. Of course, one of the major talking points will be the European Central Bank expectations. But according to the latest news, ECB President Mario Draghi is unlikely to give anything away regarding the ECB's quantitative easing exit plans. Released next week, the German and Italian growth figures advanced to multi-year highs on a working day adjusted basis, but couldn't prevent traders from questioning the sustainability of the economic performance. In fact, the stagnation in Germany's quarterly data revived worries, provided that over the corresponding period, the manufacturing PMI data had shown a top performance before the PMI figures started coming off. The declining trend is exactly what worries investors regarding the future of economic recovery. The Eurozone's August preliminary PMI figures are due on Wednesday, among Japanese and US figures. Any weakness in the data could trigger temporary price pullbacks in the euro markets, yet it is worth noting that the sentiment in the euro remains comfortably positive on speculations that the ECB will finally announce its details regarding the quantitative easing exit plans. Hawkish speculations are on the top of the game as encouraging economic data hints at tapering of the ECB monthly purchases starting from September. We recall that the Eurozone has posted 16 straight quarters of growth. This means that Eurozone policymakers have little to back off from normalising its ultra-loose monetary policy. The net long euro futures positions stand at the highest levels in more than a decade. In theory, the high speculative volumes carry the risk of an aggressive unwind. Nevertheless, in case of any negative surprise or comment, the euro traders will likely top up their positions into the September meeting and therefore are expected to remain buyers on the lows. The UK inflation stagnated at 2.6% year-on-year in July, whereas analysts were expecting a slight rise to 2.7%. Although the soft inflation has been encouraging for Bank of England hawks, the surprise rise 2.1% in wages in June prevented the pound from gaining downside momentum. This is because the faster earnings growth will have less negative impact on British households' purchasing power and could have a lighter cool-off effect on the inflationary pressures. A high inflation environment could compromise the BOE's plans to remain at historically low interest rates to sustain business through challenging Brexit times. Higher rate anticipations, on the other hand, could bring a stronger pound. Of course, the BOE is not expected to raise rates anytime soon. The probability of an interest rate hike in September 2018 is just slightly higher than 50%. That said, the confusion on data prevents the pound from taking a clear direction. The 130 level is where the bulls and the bears feel safe for the moment and could favour a mean reversion trend until the next significant event or data. The second quarter preliminary GDP data is due on Thursday. Any disappointment could revive the BOE dose and keep the pound below 130 against the dollar. The Japanese yen benefited from decent safe haven inflows as the tension between US and North Korea rose during recent weeks. The yen could have taken a brief breather, but the dollar-yen's performance has been spoiled by a broad-based US dollar sell-off after the surprise dovish shift following the Federal Reserve's July meeting minutes. In fact, the minutes revealed a surprising and unexpected split at the heart of the committee. The US policymakers were split on policy normalisation plans. They debated about the Fed's inflation outlook, the unprecedented and unstoppable rise in stock prices despite positive and negative news, and of course voiced their concerns about financial stability. The probability of a December rate hike plunged to below 40%. The US dollar yen slipped below the 110 mark in the aftermath of the Fed minutes release. Japan will announce the July inflation data on Friday and could revive the yen bears by reminding that the low inflation environment in Japan will certainly keep the BOJ doves in charge of the market and limit the downside potential in dollar yen. And finally, as a result of the unexpected dovish FOMC minutes, gold recovered last week's losses. The Fed minutes removed a major barrier to gold's positive trend. Thank you very much for watching, and don't forget to follow LCG on social media to get all of the latest research as it's released.